Hi, David. How are you?
Very well. Thank you, Dmitry.
Thank you for having me here. It's great to have an opportunity to discuss what's in store for us in terms of the UK tax policy. And frankly speaking, it's not very encouraging. All the parties have now published their manifestos, and like all tax advisors in the British cohort, I'm dumbfounded by how little we know about what should be expected. We, of course, know about the proposals that the Tory government have made. What was it, a couple of months ago already?
About 6 weeks ago, yeah.
Right, when everyone all of a sudden were taken aback by how radical those proposals are and how little background information there was. But I think even more concerning was the lack of information provided by the Labour government. And as far as I'm aware, in their manifest, they have not provided any substantive detail of how they're going to change the taxation of the non-domiciled people either. They are talking, of course, about revamping the non-dom regime, about cancelling protected trust protection, thinking about the length of the protected period. But in the end, they don't have anything substantive. And I was reading the history of remittance basis of tax. James Kessler, KC, has a brilliant book, Taxation of Foreign Domiciliaries, and in his intro has a history of non-dom regime. And I was shocked to find out that when the current non-dom regime was introduced back in 2008, I think advisors and their clients had about 9 days in April between the day the legislation was proposed and the tax year began. So we
Was that the Cameron and Osborne changes?
I'm not sure. Back then, I was not interested in politics. You see, I was living
Yeah.
in the UK back then. But there's a chance that we will see a scramble of clients doing something right now. And more clients are asking me what is there to be done. Because besides the direct effect of the drop of the non-dom status when you're paying tax on your directly received income and capital gains, of course, there's a risk of tax on undistributed income from companies and trusts and foundations these people have, and we will, I'm sure, touch about this later. So I think you wanted me to discuss what are the proposed policies, and to be honest, there isn't much to discuss because so far we've not had much to add to what we read before. The non-dom regime will be changed, but we don't know how much it will be changed.
And it's the kind of thing that they've kind of thrown out the big target. Okay, remittance basis as we know it will be gone, but what exactly will that creature look like? Protected excluded property trusts will be gone in some form, but will that be gone? Will there be grandfathering? Will there be some type of period? And kind of what's the impact of that? So I think what you and I agree on is clients should be preparing for the worst outcome and hope for and lobby for the best. I mean, I read lots of comments. Oh, we should have a lump sum Italian system or a forfeit system, and absolutely that would be smarter than getting rid of the remittance basis. But actually, keeping the remittance basis would be the smartest thing. But that's just not politically going to happen.
Indeed, a few things to add here with regards to the forfeit regime. I've heard a few people saying that why doesn't the UK introduce a lump sum charge like you just said, even if it's £150,000, even if it is £200,000 a year, you're still benefiting from the lack of tax in respect to the foreign income and gains. And if we're talking about thousands of people, thousands of non-doms, which could be affected by this, multiplied by £150,000, you've got the billions, which perfectly they will find after canceling the regime. So why not go down the simple route? Also, I think in terms of the GDP volume, the billions that they're going to find, they're quite insignificant. And of course, we're looking at the lost revenue from investments in the UK, VAT, stamp duty, land tax, etc., that all these people are contributing here. You've mentioned the trusts regime, and it's important to give due attention to the trusts. There are two aspects of trusts from the point of the non-dom. First, of course, it's protected settlements or protected trusts, which were introduced, was it 2016, 2017?
Yeah, 16, I think. Yeah.
Which would protect, as the name suggests, foreign income and gains of foreign domiciliaries. And of course, such protection will be gone. So they will be on the par with the British domiciliaries. So they will be like everyone else. And it's, of course, it's a shame, because I know that a few people have set up those trusts to protect from foreign income and gains. But I don't know whether you or the listeners are aware of this, but one probably unintended consequence of using protected settlements was to protect clean capital investments from mixing with income and capital gains. So the problem which all non-doms have faced has always been investing your clean capital into growth assets, because invariably
Right.
after you sell your share, the gain will be mixed with the base cost. And broadly, through making a loan to the protected settlement, which would make a loan to the underlying company, which would purchase the investment, and then getting the loan principal back, you could fully protect it. Now, of course, with the protected settlement protection gone, all these setups will be questioned. Another aspect, of course, is the excluded property trust for inheritance tax. Again, you could park your foreign assets in the trust and take it out of the inheritance tax net. In fact, even if you are domiciled in the UK, once you pay the entry charge, which is the immediately chargeable transfer, you pay 20% inheritance tax on the transfer of the assets in the trust. As long as you are excluded from the trust, you could, in principle, avoid the 10 daily charge, the exit charge, etc., and keep the assets protected within the excluded property trust. Whether this is going to happen now, we don't know, because I think Labour have specifically said we will remove the inheritance tax protection from assets in the trust. Again, 2 paragraphs talking about this, no substantive legislation.
Yeah, it's interesting to see kind of the human nature, and one of the things to understand for the audience is I tend to group non-doms into two different groups. One would be I'll roughly call it your city trader. They get up every day, they go to the Gherkin. They really use the remittance basis to protect the assets and the income generated from those assets prior to their move to the UK. Of course, a lot of them are going to be hit by the fact that carried interest is going to be now taxed at ordinary rates as opposed to capital gains rates. But those people have a lot of what I'll call life inertia. They need to be in the city to kind of make their money. They tend to be of an age that have children in school. They tend to have a lot of life inertia. So, I've jokingly called this, Lesperance's first law of movement, which is, somebody will stay stationary unless there's a force greater than their life inertia to move them. And for that group, they're already taxed on UK source income. So tax globally is not going to be a big deal. Same thing with capital gains. They tend to be mass affluent, low end, high net worth who can cover IHT with insurance. So they will tend not to move. The other group are kind of think your times rich list. Ultra high net worth, they've already got 2 or 3 places. They don't need to be in the UK to kind of make or maintain their wealth. And if you look at income, well, they don't generate a lot of income. Capital gains, they don't sell things, they just borrow against them. But 40% IHT on global assets, that's a big push. And they don't have as much life inertia. And so that's, I think, if the movement I'm seeing is that group are definitely moving. Now, if you look at the average amount of UK tax that a non-dom pays, it's about 5 times more than the top 20% average. But that number is very heavily skewed by those ultra high net worths. If you think of the Prime Minister's wife, for example, in the year before she decided politically no longer to take advantage of the remittance basis, she contributed 4.4 million in UK tax that year. So those ultra high net worths, tend to skew that number. Well, if they're leaving, that's going to have an asymmetric negative impact on the average amount that is donated. So I think, unfortunately, looking at it from a purely anticipating the predictable, you're not going to see the windfall that the Labour government has already spent on good things, but the money's just not going to be there. And in addition, you're going to actually see a drop in the current annual tax contribution that this group of taxpayers, has. Now, it'll take a while to show, and your average, voter in the UK doesn't understand what a remittance basis is. They just understand the rhetoric. Oh, they don't pay their fair share, but they will notice not only when those promised, goods and services don't arrive, but when the current budget squeezes call for cutbacks in even the current provisions, and that's an unfortunate outcome.
Indeed. That's an interesting term you're using, the life inertia, because up until even a few months ago, I thought that no one would leave voluntarily because so many people are so deeply entrenched in life in the UK. They have properties here, children here, etc. But a few of my clients have said that they're prepared to go abroad. The problem, of course, is that there aren't that many places for them to go, and I think you wanted to discuss this later. I won't spend too much time talking about it now. But broadly, it's the quality of life which will suffer, and the cultural aspects and proximity to other countries, etc. And I've had to go through different options with my clients, and invariably, objectively, the UK is the best, except of course for the weather. But having said that, they're still very keen to live. With regards to the expected worldwide inheritance tax liability, I just cannot believe how little information we have about something so crucial for so many people. We all know that it is going to change, but whether it will be the 10th anniversary charge after you leave in the UK, as Tories are proposing, or will be something else, if you are just tax resident in the UK, clearly it's absurd to expect you to pay inheritance tax on a worldwide assets if you've only lived here for 1 year. And this is the problem. We have our colleagues, our esteemed tax advisors colleagues, who speculate about what's going to happen, but the politicians are not providing any answers. And again, from what I read, I'm sure we read the same sources, hopefully there will be pressure on the politicians to come up with something tangible in the coming weeks or months so that people have some predictability. But yes, I agree, it's absolutely absurd the amount of tax they'll have to pay if they die.
Yeah, it's the hope for the best and lobby for the best and try to get them to, the governments to kind of appreciate these things. The will they leave question is often confused. There was a London School of Economics study that came out a few months ago that said, well, people think they're boring and they would never leave. First off, the sample group was at best a few of our type 1 city worker types. So they weren't really looking at the options. The second thing is they were thinking, I'm going to go to Cayman for a week. It's nice to sit on the beach, but once I've golfed all 3 golf courses and swam at Stingray City a couple times, I'm going to get bored there. And they don't realize that there's actually a lot of different options. And one of the keys is when we look at different options and jurisdictions, it's got to sell at the breakfast table. So you really do need to understand what all the family needs are. Do you have children who need to be in school? What's the quality of those schools? What's the weather like? What type of infrastructure do you need? Medical. And the other thing to understand is, while you're probably going to have to be very careful with regards to your day count in the UK not to become resident there, it doesn't mean that you can't go to the Chelsea Flower Show or to Ascot or whatever else you want to. It's not like you're banned from the UK permanently. And in addition, if you're moving to a tax treaty jurisdiction, you may be able to challenge the most straightforward tax residents by taking a treaty position. So it kind of puts you beyond kind of here's our day counts, here's our factors, here's our Robert Gaines Cooper factors and things. So again, that all comes into the choice. And when we look at the choices and the types of places that people have, they fall into kind of a couple of different categories. What I'll call the pure tax haven. Think Monaco, UAE, Bermuda, for example. And for some people, that's a great lifestyle. For other people, it's just not going to sell at the breakfast table. Then you get the second round, and let's look at kind of the European destinations, the remittance basis jurisdictions like Ireland and Malta and Cyprus, the lump sum jurisdictions, the Italy, Greece, and Switzerland, and the ones that have some type of regime like the NHR or the new regime in Portugal. So, clients can sell that at a breakfast table for a lot of them. You then look a little further afield and you've got jurisdictions that have territorial taxation, Singapore and Hong Kong, for example. You've got other jurisdictions which don't have a state tax, the Canada, Australia, New Zealand. And they do have income and capital gains, but you can blunt that or even minimize that with proper pre-immigration tax planning. And finally, you've got the US as a jurisdiction, which has a state gift and estate tax, doesn't have wealth tax, but it has a very high exclusion. I mean, whenever I mention what the nil rate is to an American advisor who's looking at 12.7 million exemption on estate tax, they just go, yeah, they properly labeled it the nil rate because it's so low in the UK. So again, for that low end, high net worth, and there's a lot of pre-immigration tax planning, drop-off trusts, etc. So even the US will work. So that LSE study that was comparing London to, all due respect, Guernsey, no, that's not really the choices.
Yeah. You've mentioned a few interesting points where I just wanted to comment on them. With regards to the double tax treaty residents, you're right, of course, if you're moving, say, to Spain or to Italy or to Cyprus, for example, you will, of course, be liable to tax there, you will become tax resident, and you can rely on the double tax treaty. Even if you are tax resident in the UK, you may be able to escape UK tax. But I think it would be quite difficult for you to prove that all of a sudden your center of vital interest has moved from the UK abroad, and while you are continuously resident in the UK, you're no longer subject to tax there under the treaty. Imagine you lived here for 10 years and all of a sudden you're saying, oh, I'm moving my life to Spain or to Cyprus. How will you do it? This is one thing. Another aspect is that, of course, UK's tax year runs from April to April. So we're talking about 2 continuous tax years somewhere else, 2 calendar years, which will fall over the 1 UK tax year, which, by the way, gives you an interesting planning point, because if you, so the tax year in the UK ends in April. So if you, say, live physically in the UK, say in May, and then from May until the end of December, you move around the world, not spending more than 3-4 months anywhere in the world, and then you establish yourself somewhere else, say in Spain, after January of the following year. You will have the period of non-residence from April till December, where you can cash in, get your clean capital, and then move somewhere. And absolutely legitimately, you
Step
will.
up in basis, yeah.
That's right. Also, yes, of course, the UK does not have any lasting residence provisions like the States or Germany or uh, Ireland, I think. Once you leave the UK, any income or gains that you earn after you leave, you don't pay tax on it. There's a rule, of course, which says that if you come back to the UK before the expiration of the 5-year term, it will be subject to tax, but you can plan around it. So there's a way to do it. Although, of course, it's important to remember that even if you are treated non-resident in the UK, your residence will continue counting towards your domicile exposure and potentially towards your inheritance tax exposure. Now, of course, they're planning to replace the current domicile system with something else. But if they say that if you have been UK resident for 10 years, then you're subject to inheritance tax on worldwide assets, then even if you're treated non-resident but domestic law resident in the UK, you will still remain within the risk of inheritance tax liability. We don't know how it is going to work, but we have to consider this. Another aspect which some people don't realize is that on the one hand, the UK has a mechanical system of determining residence. If you are fewer than X number of days, then you're not resident. But there's a particular aspect which is often overlooked. Imagine you have a home in the UK, proper home where you've raised your children. Then you go abroad and you start traveling around without establishing a proper home. Say you decide to become a digital nomad, spending a couple of months everywhere. By virtue of keeping a home in the UK under one of the automatic UK residence tests, you will remain UK resident even if you're spending any significant days there. And one last thing which I wanted to say is that at least twice recently I've heard about rumors that they're thinking of introducing uh, an American system. Like if you are a citizen or somehow connected with the UK, you'll pay tax on a worldwide basis. This is literally rumors, but I've heard more than once. So I don't know if you've heard about anything like this in the UK.
Well, so a couple of things. Number one is you're quite right. It's difficult to kind of, wait until, they do the November announcement and leave, the next day, or, decide I'm going to leave just before the April implementation date. There's a runway. It requires, you need to, get a new pied-à-terre. You need to get residence. You need to get immigration status. You need to get children in school. There's a bunch of things that need to be done. That's why we have a lot of clients right now who are weighing what I'll call fire insurance and a fire escape plan. They may not ultimately decide to pull the trigger until they've got a better idea of what is ultimately going to be the rules. One of the things I mean, as somebody who looks at a bunch of different jurisdictions, one of the things that I was pleasantly but still surprised about was the UK doesn't have an exit tax. Unless, of course, you're foolish enough to be a member of the House of Lords and deemed domicile and resident. We won't go into any specific names of people that trip that up. But so the U.S. does have what they call an exit tax, Section 877A, for what they call covered expatriates, people who give up their U.S. citizenship or long-term green cards, who have more than 2 million in worldwide assets, which of course all of our clients would. And they have an exit tax. And the UK, I can see, anticipating the predictable when Labour discovers that there's not as many, cookies in the non-dom cookie jar as they thought. What else are they going to look to? Well, increasing capital gains tax, they're already talking about. Expanding the scope of IHT and getting rid of some of the exclusions, a wealth tax, a VAT tax that would be increase would be a tough one, because that of course goes across the board with all their voters. So they want to target, the people who probably aren't Labor supporters already. So if you look at kind of those areas, you can see it. Will they do a pension grab? There's a number of different things that they can do. I mean, I don't know, Dmitry. I wasn't horribly surprised that carried interest was on the chopping block. It's been kind of targeted for a while, and quite frankly, I'm surprised it lasted this long. Assuming A, Labor gets elected, and B, that they actually kill, tax carried interest as ordinary as opposed to capital gains. But I can see anticipating the predictable. And so I'd be interested to know if you've seen the same thing, but I've started to deal not only with non-doms, but actually with UK doms, of course, who have a much stickier wicket than your non-doms do. And when I say, domiciles of origin and deemed domiciles, have you seen the same type of thing?
I Are you asking me if I've seen any rumors towards
Have
the
you
left?
seen an increase in UK domiciles who are also, worried about the proposed changes by Labour and kind of, eyeing a potential backup plan?
No, I have not. Partly it's owing to the fact that I tend to work mostly with non-doms. Second, the only thing which I think will affect the domiciled individuals, few things. First of all, is the abolition of the business investment relief for inheritance tax.
Yeah.
They already think of curbing it in this respect of AIM shares, etc. But in respect of trading companies, that would be a shot in the foot. And also the potential increase in capital gains tax rate, because apparently the UK is an anomaly compared to other countries. So this is the only thing which would perhaps matter to them. So I cannot give you sizable statistics about the DOMs. I just wanted to come back to what you were saying about the proposed measures, or at least potential measures that they could do. I think there was a wealth tax committee which found that wealth tax would be counterproductive. So I don't think we will have wealth tax, nor has any party proposed a wealth tax, which would be a sensible proposal. I think we're okay about this. VAT, we can't really comment on that. It is a sizable amount of tax, but from what I recall, I think it is income tax which is bringing the most sizable receipts, not VAT.
Hmm.
But it would perhaps it will be better to increase consumption taxes and VAT to bring more revenue, but I cannot comment on that. But what interests me more, of course, are exit taxes. You have correctly said the UK does not have the individual exit tax, but there's a but. There's no exit tax if you're not trading as a sole trader, if you're not pursuing your own trade. Now, I perhaps am being pedantic here. Show me how many non-doms are pursuing traders, sole traders. But nevertheless, if you are running a home consultancy as a sole trader, then when you're leaving the UK, you will face exit tax. But what's less obvious, but just as important, is the potential exit tax on companies, which these individuals are running. If you are
Hmm.
as non-dom and you're running a trading company in the UK and you are its director, not a shareholder, director, by physically leaving the UK, you will be essentially dragging the company with you because you will no longer be managing and controlling it from the UK. And you should either resign or you should appoint someone living in the UK, or you should commit to coming to the UK regularly to manage and control it from there. Whether they
Yeah.
will use exit tax, I don't know. To me, really, the new proposals, they seem to align taxation of domiciled people with non-domiciled. Already they have their plates full with non-dom legislation. Whether they will review the existing exit tax legislation, when will they have time? Who knows?
Well, I think that's kind of the next layer. The first, they're obviously going after. If we take Rachel Reeves at her word, they're going after the remittance basis and however they're going to do that, and they are obviously going after the IHT for those non-doms with the proposals they have. You're quite right. The one of the things I do not see is a citizenship-based taxation like you have in the United States, for a couple of reasons. Not that UK politicians are any less avarice than than Americans are. It's a very difficult system to actually implement,
Yep.
and it would require basically a wholesale rewrite of major parts of the legislation. I know the Canadians thought about it and kind of when they got really down to the details, no, we can't really do that. The French thought about this, and when they got down to it again, the other way the United States is actually they've had it a long time, basically first time since the Civil War, second time since they kind of permanently brought in an income tax after the First World War, is the U.S. world reserve currency. So they've got the power through, for example, FATCA, to enforce it with all financial institutions in the world, because every financial institution needs to have US dollar correspondent banking relations, and they need to invest in the US market for all their customers. So with the qualified intermediary regime, US has got the leverage that even a UK or Canada or Germany or France just don't have that leverage.
I think what you've said so correctly is that the US have had years of experience doing this, and the IRS have all their might. Just recently, I was discussing this with someone about the citizenship-based taxation in the UK, and he said exactly that. The IRS have had years to hone their skills, whereas the UK is taking weeks just to send out a single bloody letter. They don't have the capacity, unfortunately. So we probably should not be expecting this.
Yeah, again, I'm sure they're thinking about it, but when they get right down to actually trying to implement it, now also you have to remember the bulk of that tax legislation in the United States has been written subsequent to the existence of a citizenship-based taxation. So their entire code is built upon citizenship-based taxation, whereas this would be a completely new angle for any other jurisdiction, which was had a residence-based taxation, which is a good thing if people are looking to acquire, other residences or other citizenships. I used to, I did my first U.S. expatriation in 1990, and as somebody who grew up in the border, I used to get all my Americans, I was bringing up to Canada at that point, and say, when y'all going to start taxing based on citizenship? And I wrote our then finance minister, later Prime Minister Paul Martin, as a friendly Canadian suggesting it, and he actually signed the letter. I'm sure some flunky wrote it, saying such a change would be a fundamental and far-reaching change to the Canadian tax system and one we don't contemplate doing. And that complication back in the early 1990s still exists, in 2024. And so, you may get, those who push for a wealth tax, like Trade Union or the Guardian and Polly Tolenby kind of proposing such a thing. It's going to be very, very difficult to impossible to actually try to do, and it's certainly not going to be something you're going to do, before a November budget or an April implementation.
Indeed, indeed. So where would you suggest people should be going from the UK? You touched upon it quickly, but maybe you have a suggestion of suitable
Well,
country.
the first thing they need to do is, calculate what that potential tax bill will be in the worst case scenario. So that gives them the force. Then really understand what makes up their life inertia. So, as a father of 10-year-old twins, our decision on where to live is very much driven by where the kids going to go to school. I just haven't the patience to homeschool, so that I'm going to be somewhere 9 months of the year. But with that, with things like, international schools, international baccalaureate, British systems around the world, there's a lot of different choices. Monaco, for example, used to be a place that families avoided. Well, their schooling has increased, quite dramatically. That the housing options have increased dramatically. It was tough to move from a big farm in Kent to a flat in Monaco. Now you've got, other options. And so the jurisdictions, Dubai has come a long way. I first went there in 1990 when there'd be gaps, between even Sharjah and Dubai, let alone Abu Dhabi. It's changed. Some of that is good change, some of it is bad change. So you really have to understand what are your family needs, how long will you need to do that, and having gone through that myself a couple of times, that's really the discussion that needs to be had. And so I'm actually doing a webinar, which will be already done, looking at 17 different jurisdictions and kind of giving clients what their different options. But as I said, it tends to fall into the tax haven, tax favorable because of some regime or tax planning, but it's really kind of what places work for clients. I'm having a lot of clients consider the UAE. I've got a lot of clients considering they like a lump sum in Italy or Greece. I've got some clients, particularly those who have gone on to get a UK passport, because they automatically, under the Common Travel Agreement, have the option of living in Ireland. I've got clients that, Malta and Cyprus fit better for them. got a lot of clients in Portugal. There was a lot of misinformation that the golden visa program kind of died, and it's like, well, no. First off, if you want to get a residence permit in Portugal, if you're going to be there more than 6 months, you don't need to make any investment. You can go under the D7. If you are not going to be there, that long, because you gallivant around because you don't have kids in school, then you go for golden visa. But then it just means there's not the real estate option anymore. You have to invest in 500,000 euros into a fund, which is an investment decision. And so it's really kind of lots of options, and really understanding. I mean, I used to get American clients who would hire me and say, move me somewhere where there's no taxes, no divorce lawyers, and no litigation. And my kind of glib answer would be, okay, we'll move you to Pitcairn Island. Only 38 people on earth have decided that that's where they want to leave. Oh, no, I want airports and schools and hospitals. And okay, so, what are the jurisdictions that will meet all of those needs that will fit your budget, fit your timetable, and will be more tax efficient than where you're at right now? And there are a lot of choices. That's just that LSE study did not look at all the possible choices. They picked kind of the cliche small island tax havens, and again, didn't ask that type 2 ultra high net worth non-dom. They asked, the one percenters, many of whom weren't even non-doms, who'd never lived outside of the UK. Been on a vacation. Oh no, I could never live there. I can go on vacation. So I think there's a gross misunderstanding, and we understand it because you and I are actually talking to the clients. We're not, LSE or University of Warwick academics in an ivory tower asking the wrong questions.
Indeed. It is a bit strange how all the non-dom changes are based on this report. And I guess here I'm just quoting opinions of people much cleverer than me, but what everyone is saying, that there is not much substance in this report, and I'm sure it's been talked about ad nauseum. I will just say that it's strange that this is used as a basis for such cardinal reform.
Yeah, I mean, you and I are probably reading the same people on Twitter, kind of the leading lights in this area who are ripping it up. But even a mere colonial like me, challenge Arun Adnani on sample groups and what questions you're asking, what did you ask and what did you not ask. They were really based on the Cameron Osborne changes when they brought in the remittance tax bill, and not a lot left. Again, look at the type as opposed to the group. Well, again, to your ultra high net worth, paying what to them would be what an accountant annual fee for that's not going to be enough of a push for them to overcome their life inertia. But 40% on worldwide assets, IHT, that's a push.
Indeed.
And to quote one of my clients, London's nice. It isn't that nice.
That's a good way of putting it. This was a fascinating discussion. Thank you so much for having me over and sharing.
Well, thank you, Dmitry. Yeah. It's a pleasure. One of the things we some of the files that we're deal with, we get to deal from the front lines, and it's interesting the difference in the attitude of the targets of these proposals from the predictions made by those who are, putting forth those proposals.
Indeed.
Well, I'm sure we'll be talking again as the election results become clear, and as we get more clarification on what Rachel Reeves has in store for us all in the future.
That's right. Thank you so much for having me there, and yeah, let's address this when we have more information.
Great. Wonderful talking. Thanks, Dmitry.
Have a good day. Bye.